Hello, welcome to the May 2018 edition of Tax Talk. My name's Anita Monteith, and with me today we have Sue Moore, our private client tax manager.
Good afternoon.
And Peter Bickley, who looks after employment taxes and national insurance.
Hello.
We have a lot of things to talk about today, as always. We seem to be swamped with consultation documents, so we're going to be doing some of those. And we've also got a whole host of practical issues that have been raised by your volunteers. So let's make a start. Sue, we're going to kick off with capital gains tax on the sale of residential properties.
Right.
Over to you, 30 days. How's that going to work then?
Yes, it's this had already been announced. There's a consultation out at the moment, which is just a technical consultation about how it's going to operate. The policy's already in place, so it's not asking for comments on that at all.
Right. This is the capital gains tax.
It's capital gains tax on residential properties. The non-residents have had it for a little while, and we all know how well that went. It's now going to be for everybody who sells a residential property in the UK that's liable to capital gains tax.
Right. Second homes.
Second homes, yes, or it could be your main residence, but it's not been your main residence throughout.
Right.
And so there's some tax payable.
Buy-to-lets, if you sell one of those.
Buy-to-lets, yes, or if it's mixed-use property. You've got the flat and the shop underneath.
Yeah.
It would only be the flat that you'd be talking about. But what you've got to do is you've got to report the gain and the calculated gain within 30 days of completion. So not exchange, which is the trigger for the capital gains tax. It's 30 days from completion, and you've got to pay the tax over in most cases.
Okay.
Why wouldn't you pay the tax over? Well, it could be that you've got a lot of losses brought forward, and you can set those off against the gain, and so there'd be no tax to pay.
So would you do that sort of obviously in advance of your self-assessment tax return?
Yes.
Would you put it on your tax return?
Still needs to go on the tax return. And of course you might have an issue. Say for example, exchange of contract was the 31st of March and completion is the 10th of April.
Oh, I hadn't even thought of that. Spanning 2 times. More problems.
It doesn't change the fact that the gain is reportable in the tax year that it was sold, which was the 31st of March one.
Right.
But you've still got to do your notification and pay your tax within 30 days of the completion, which was the 10th of April in my example. Okay. It will have issues like that. If it's an overseas residential property that you've sold, then if there's tax to pay in that overseas country, that will, under the double tax treaties, cover the tax liable that you've got to pay in the UK, then again you don't have to pay it.
Right.
One issue that's causing people concern, because what a lot of people do, they sell their buy-to-let, they've got a gain of X pounds. Oh, I've got that shareholding, that's standing at a loss, I'll sell that. But losses that you make after, you can't anticipate.
No.
Oh.
And so you wouldn't get that back.
Can't go backwards.
No.
Well, you'll get it back when you put in your self-assessment
Yes, you will do
revenue
ultimately. But a lot of
calculation.
people do work like that. You know, they've got their gain. Right, what have I got that's standing at a loss that I can sell to reduce my liability?
So what would you do? You'd pay your tax and then you come back to it later. And claim it back.
Yeah.
So if you've sold your share at a loss before exchange, then can you offset it?
Yes. Any losses that have actually been realised before, then yes, that's okay.
So it's just if you realise them after the date of exchange, then it's too late until you do your return.
Yes.
So that's actually a really important practical point, isn't it?
And I don't think it's actually the date of exchange that matters. I think it would be before the completion, but I don't know. We've not got the nitty-gritty of that. It's just that if the loss is created after the actual disposal, and as I say, I don't know if it's the exchange or the completion date that's the critical mark.
So will there be a special sort of portal to make your return on? I assume there will be.
I think we're getting a bit practical.
Something
that's still a consultation
All I can
stage.
say is that the non-resident CGT didn't work terribly well. People weren't aware of it. Their position's going to change as well, because at the moment non-residents with their CGT, if they're already in the self-assessment system, they've got to report the disposal within 30 days, but they don't have to pay the tax until the normal due dates for self-assessment. Well, that will change. All of this is going to happen from April 2020. It was originally announced it was going to be from April 2019, but that didn't work with other changes that they were making as well. And so it's April 2020. The consultation is open until the 6th of June 2018. So if anybody's got any comments they'd like to make about how it's going to work practically, either let me have them. There's a news item on the website, so you could put comments on there, or indeed you could complete your own response.
And as you can see, Peter and I have already started asking what-if questions. So I feel sure that there are a whole load of other people out there who can think of some more. Please send them to Sue and she can pop them into our consultation response. Thank you very much, Sue. Peter, the PAYE deadline, that is now looming.
Yes.
So we're up to year-end stuff.
Yep.
How's it going?
How's it going? Well, what's everyone got to do? Well, they will have done the year-end pay-as-you-earn final FPS, I hope, by the 5th of April. Payment date for the last pay-as-you-earn is 19th of May or 22nd of May if you do it electronically. Better check whether it's a Saturday or Sunday. I haven't looked actually, but that's always worth doing. Make sure you pay by the Friday. And then probably...
So if you do a reconciliation at the year end and you find that you come up with a different number to the HMRC...
Well, it's best to pay what you think. I think it's best to pay what you think is the right figure, because revenue systems not always processing things correctly still.
Have you had more reports then, reconciliations being tricky?
Well, it's not... Yes. I mean, there are still instances of apparent underpayments and duplicate employments and all the rest of it, because nothing much has changed since RTI was put in, although there are less duplicated employments than there used to be, because the revenue runs routines take up the obvious ones, but there are still problems in RTI, I'm afraid.
And you volunteered, haven't you, to help with the post-implementation review?
That's right, yes. We wrote into the revenue on the 2nd of February saying, would you like us to help you implement the post-implementation review? And we did get a reply, but it was positive in some respects, but perhaps not as positive as we would like. So we've written back saying, perhaps a good idea perhaps to have a meeting and talk about how we can help.
Your life is full of meetings to discuss RTI, it seems.
Well, it feels like it. But
and the P800 process, that's for employees who aren't in self-assessment.
That's right.
That's going ahead. When will we see the P800s appearing this year?
Well, I think normally it's in the autumn, isn't it?
Yeah, September
October
time.
Yeah.
Do HMRC actually finish their year-end checks before they issue them?
Well, I believe that the reason they don't go out until September is so they can reconcile the best they can employee and employer data. So they are meant to be fairly, they're meant to be a final picture, but obviously things slip through because of processing problems. So it's always worth checking your P800, just like it's always worth checking your notice of coding.
Yeah.
I see that the rollout of the simple assessment and the dynamic coding, which is all connected with the P800, I see that's on hold as well, and I think you're going to come back to that later.
I was going to say so. That's for later on, but since you've mentioned it, let's just quickly cover off that one now. John Thompson, as everybody is aware, gave evidence to the Public Accounts Committee way back now in end of March. And following that, it was announced that they were going to be reviewing the HMRC work programme, and as a consequence of that, there were going to be certain projects that would not proceed as planned in order to free up some time and some money for the new Brexit programmes that are needed. Several things have been cancelled altogether, but making tax digital was one part of the programme that has been under the microscope. And there has been some confusion around what is and what is not going ahead with MTD. Bearing in mind that there are actually two bits to the MTD programme. You've got the MTD for individuals and the MTD for business.
Business including rental.
Yeah. MTD for business is the trading and property income, quarterly reports and all of that, and of course VAT. The MTD for business programme is going ahead as per Plan A. So
I think.
So MTD for business, starting with VAT in 2019, is going ahead as planned. The pilots are just about to start for that. MTD for income tax pilots have been going now for a year, and I think that's now moving into public beta, so more people will be going into the ongoing pilots shortly. So 2019 for income tax. We still don't know exactly when it will start for
2019
for VAT. We still don't know exactly when it'll start for income tax. They've said 2020 at the earliest. We'll have to wait and see there. However, the bit where we will see some changes is the MTD for individuals programme. Part of that was simple assessment, and that was what you were referring to just now. The simple assessment for pensioners will continue. So it is still intended that they'll use simple assessment to collect PAYE on state pensions that are being paid over and above the level of the personal allowance, and that will be starting next year as planned. Rollout to the rest of the population is the bit that won't be happening as planned. We've had a few more details about what will and won't go ahead. I think, for instance, the Bank and Building Society interest, pre-population of that, the intention is that they're going to go ahead with the joint accounts, populating that onto self-assessment returns. But we will do a news item when we know exactly how and when that will all take place. So that was a very long answer to a very short question, but I thought people might be interested in a bit more of the detail. Meanwhile, Sue, you were just trying to get out of talking about the OTS simplification project for inheritance tax, weren't you?
Yes. The Office of Tax Simplification has been asked by the Chancellor to look at inheritance tax and how it could be simplified. I'm part of the consultative committee who are helping the OTS. So they use consultative committees to get technical information and practical information about whatever they're looking at. And so it's technical people and people in practice. Excuse me.
So with the inheritance tax consultation, they are actually looking at the whole thing, aren't they? It's not just a one little bit.
It is, yes, but they are aware, of course, that there is promised a consultation on trusts and tax that the
That's what the Chancellor said.
Announced. And we're expecting that sometime this year. I don't think we've got a date for it yet, but that will be a consultation. It will be the third or fourth attempt in the recent history at trying to simplify the tax for trusts. The previous ones have not gone well. They've come up with ideas which in fact are more complicated than what we've already got.
That keeps happening.
Well, the thing is, inheritance tax in itself is quite simple, believe it or not. It's quite a simple concept. It's when extra bits have been added. And so reservation of benefit, that was added after the initial concept of inheritance tax. The residence nil rate band, of course, has been added. And with the downsizing provisions for that, it will get more complicated as we get further away from when it was introduced.
Yeah.
And it's those twiddly bits. In terms of inheritance tax in trusts, agents can spend hours working out that there's tuppence halfpenny to pay on the periodic charge. and then the trustees say, well, why have I got this enormous fee when there's no tax? So anything that can be done to simplify the periodic charges, you would be welcomed. But having said that, generally Joe Public doesn't need to know how the 10-year charges work. And professionals who do need to know are generally well versed in it and understand it. So although it is complex, if you've got the records and you're used to it, in essence it is simple. So
I think with inheritance tax, it's the sort of DIY IHT planner that tends to mostly come unstuck.
Yes, I think
gifts with reservation, giving a house
yes,
away.
and I think one of the problems as well, people are very frightened of inheritance tax. I've had a number of clients, potential clients, come to me, I'm really worried about inheritance tax. And the first thing I always do is say, right, let's make a note of what you've got in your estate with some estimated values. And frequently we get to the bottom line and I say, well, you're below the threshold. Well, what's the problem? You don't have an inheritance tax problem. And as I'm discovering with my mother, if you go into a care home, you certainly don't have an IHT problem because it all goes in care fees.
Which brings us on to the Resolution Foundation's report on intergenerational fairness.
Yes, they're compiling a whole series of papers on intergenerational issues, and one of them, which was published last week, is on inheritance tax. And the chap that wrote it, in fact, came here, and I met with him along with one of my volunteers.
Was he a tax expert?
No, I believe he's got a degree in physics. I think that's what I read about him on the website. But then I've got a degree in biology and pure mathematics. So
and that doesn't stop us holding forth on tax. No.
So
can I just say you are a chartered accountant and a member of the CIOT as well, just in case anybody's wondering.
And STEP.
And STEP.
So he's come up with some very broad proposals. They are very extreme proposals. He's got a lot of press coverage for the report. They are very extreme views. I don't personally agree with most of what he's said in there, but you do need to have extreme views in order to stimulate discussion.
And good for them, they have.
Yes. It has generated a lot of discussion about people of my generation paying more so that 25-year-olds can all be given £10,000. I don't know what they're going to do with the 10,000. It's suggested it can go towards a house deposit or towards training so that they can get new skills. So he's come up with ideas like that. In terms of inheritance tax, basically what he's looking at is a capital acquisition tax. Inheritance tax is a capital transfer tax, so the person giving, the tax is calculated based on what they've done. A capital acquisition tax, which is what most of Europe who have IHT have, including Ireland, is the person receiving it has got an allowance, and anything above that they pay tax on based on what they've received, regardless of what the person has given to others.
Now, there are over 200 pages in this report, so we've done a newswire this week, and if you're interested in this, then please do look at that news item. One of the other aspects they were looking at was, of course, Class 1 national insurance there. And they have suggested, for instance, that Class 1 NICs should be paid by employees who continue to work over the state retirement age. Peter, what do you feel about that? I mean, I don't mean the actual point, but tackling that area.
Well, there's a lot that needs tackling in that area. It's not just what employees pay, I suppose.
It's the age issue, isn't it? You segment it.
Yeah.
It always used to be said with national insurance before we got the extra 1% and then 2% was once you'd paid that amount, that you didn't have to pay any more. And we moved away from that with the extra 1% and 2%. So should potential pensioners pay it if they're in employment?
Well, it depends if you're going... if they're in employment, then arguably they should.
But you can earn £6,000 or so before you would pay it anyway.
Well, it does encourage you to take on two little jobs rather than one big job because of the each for national insurance, each job is dealt with as a separate entity. So if you keep yourself below the primary threshold, then you don't have anything to pay.
But if you're over pensionable age and you've carried on working because your pension's insufficient, then you have to pay national insurance. Should we also look at national insurance on the pensions that pensioners are receiving because they've been able to give up work because their pension is good enough? Should they pay national insurance? So the argument can just go all around.
But we keep using national insurance and age to influence different activities. So, for example, we've got the 21. So, for an employer taking on individuals under 21 who don't have employers' NICs, under 25. For if they're on apprenticeship, then you don't have employers' NICs. And then we've got under 16s, obviously.
And for small businesses, you get £3,000 gift. For your employees, well, everybody gets it, but that encourages the smaller businesses to take on an employee because they haven't got the payroll tax, because they don't have to pay the employer's national insurance.
So it's horrendously complicated now, and that probably brings us on, Peter, to something you've been working on. In fact, you spent all day yesterday in serial meetings, didn't you? And that's the future of work.
Yeah, future of work and employment status, and this follows on from the Taylor review, in which he brought out last July. Good work. And the Bayes DWP Joint Select Committee report, which came out also last year, and following which the government put out a response and 4 consultations, one of which on employment status. We've written to Mel Stride, the Financial Secretary, saying that we need a national debate on this area because employment, the way in which people are taken on, is driven by tax, in my opinion, mainly the employer's national insurance, which is a big cost. So that, together with all the employment rights that you have to give, all the hassle and expense of running a payroll through which you have to pay apprenticeship levy, so it rather discourages people and giving people employment rights, auto-enrolment, discourages people from taking on employees, take them on as non-employees. Perhaps you hire them through their umbrella companies or one-man companies or personal service companies or whatever. So the whole thing is being driven by the cost and hassle and the overall cost of having employees, which is making everything a bit lopsided, I think.
And we've been here so many times before, but this area is just politically toxic, isn't it? The idea of raising more tax through
the government,
employment status.
Yeah, when Hammond did try in the spring of last year's budget to equalise national insurance contributions. Caused outrage.
Every self-employed person in the country manned the barricades.
Well, it was in the manifesto, so he had to withdraw that. But I think the only way that a solution will be found is probably to equalise the tax or the cost of taking on people by whichever means you take them on.
But will government embrace that? Can they?
Well,
if they've suggested it, won't they immediately be voted out?
Probably, but I don't know. But the government, we saw Treasury and Revenue yesterday, and they said the government's not looking at the moment at equalising tax rates.
Right.
So they're really looking at status. Is there something that can be done there? But probably the tests are right, and the national insurance, the Ministry of whatever it is, the ready mix concrete case with the Minister of National Insurance, 1968, is still the leading case. That was confirmed in a case quite recently. So the tests are still
we just
the right
stuck.
one. Well, they could change it, but I think then everyone would have to learn new tests. There's a question in the conduct: should one codify it? Codify the tests.
By that you mean put them in law?
Put them into law. I mean, in our response, we have put a suggestion in the annex.
We had a go, didn't we?
We had a go,
codifying it,
but almost to show how
difficult it is.
And it would take away flexibility from the courts, because the courts are very good at at looking at the facts and working out
what's actually happening.
You know, it's not just the contracts, it's what's happening. And they sort of stand back very well and take a sort of civilised, sensible view of it all.
Off-payroll working in the public sector has now been with us since April 2017, so more than a year. There are concerns that it's going to be rolled out into the private sector, and we're expecting a consultation on that any time.
Yeah.
Now, we did actually pick that up in a letter to the Minister as well.
Yeah, we did.
And we have said, I believe, that we feel that there are some fundamental matters that need to be addressed first. First of which is, of course, the accounting issue.
Yes, as accountant, that's high on our list.
It is, it is. And again, we have a meeting, I think it's going to be tomorrow, the IR35 Forum. Sarah Gavari is going along to that to discuss the accounting issue. The question really is whether the amount in the PSC should be shown as the net or the gross amount that's invoiced to the PSB. We will see what HMRC produce at tomorrow's meeting, and we will, I hope, persuade them to publish some guidance on that as soon as possible. You've also got concerns that you've raised in this letter about the assessed tool, haven't you?
Yeah, well, it was really designed for the public sector. It doesn't really deal with mutuality of obligation.
Right, yeah.
It doesn't really ask enough questions to get, to get to the
so
bottom of the case.
that tool will need to be fixed.
So it needs to be
before.
fixed, and it needs to be perhaps made a bit more accurate. I mean, the revenues stand by it, but it's not. It's not brilliant.
More work is needed.
It does need a bit more tool. The other item we're concerned about is the workers who are treated as deemed employees in the payroll of the fee payer, which is the person who immediately pays the personal service company. There's no flag. Payroll software providers are not being given a spec within the revenue to put a flag in to denote that the worker is a deemed employee. So that means in an automated payroll, the student loan start notices are just processed automatically, and of course that should be done by the worker's personal service company, of which he is a proper employee. Auto-enrolment deductions potentially have been made. So
these are very practical issues that need to be resolved. And is that letter now published on our website?
Yes, it was I can't quite remember which,
but
it went into a fairly recent news
representations.
item. Yeah, so the letter to the Minister and also our response to the employment status consultation, both up there.
Thank you very much.
Publicised last week, actually.
Excellent. Sue, there's just one point you wanted to make on pension schemes and express trusts.
Yes, Trust Registration Service.
Oh, it's your favourite subject.
Where would TAXtalk and News Vibe be without Trust Registration Service? Yes, any express trust, so that's one that's been formed with the intention of it being a trust, so rather than a statutory trust or whatever, that has a tax consequence has to register on the trust registry. So tax consequence, that can include the taxes are listed and include stamp duty land tax and stamp duty reserve tax. So bodies that don't pay tax normally, so like for example a pension scheme, they could have a stamp duty reserve tax because they're buying shares. And so, in theory, should register on the Trust Registration Service, and there has been some debate about this. And HMRC announced last week that any pension scheme formed as an express trust does not have to register on the Trust Registration Service if it is already registered with the HMRC's Pension Scheme Online service. So, which does a similar sort of job.
Bit of good news.
It is, yes, yes. So you only have to register the one. So pension schemes that haven't registered should not now receive penalties.
Excellent. Well, that's
providing they're on the Pension Scheme Online.
That's great.
Yeah.
Good news. And while we're talking about pension penalty schemes, penalty schemes?
Penalty schemes, yes. The Trust Registration Service penalty scheme was actually announced in March. But we're still looking at it. It's not satisfactory. It's a tax-geared penalty. But the trust registration is an administration thing. In other countries with a similar sort of scheme, because it's all part of the EU money laundering regulations, it's their trust registration equivalent is run by something like Companies House.
So you would expect to see flat rates,
like if
rather than tax geared.
If you don't file your company accounts on time, you get £150 penalty, and then it racks up depending on how
And
long.
I feel sure you have a letter pending
yes,
on
there
this.
is a letter pending.
Representation
because it's inappropriate
made.
that it's tax registration service, but it's a tax geared penalty. Because if you haven't paid your tax, you will get your tax geared penalty.
Sue
as
gets
we would
very
expect.
outraged by these, as you can see. So you can
Yes.
expect a strong letter going
Yes.
in on that particular point.
And quite right too, I would say.
Well, that brings us to the end of our tax talk for today. Just a few things to flag. We are going to be on the ICAW stand at the Accountex exhibition on the 23rd and 24th of May. Accountex is going to be at the Excel Centre in the Docklands in London, and there you will be able to find all the software you could ever want to imagine to help you with your practice and your business, but more importantly MTD. Please come and find us on the ICAW stand because we would be delighted to talk to you about making tax digital and in particular the tax faculty, because we will also be relaunching the tax section on the ICAW.com website. And many of our lights that have been hidden under the website bushels will become very, very clear. So please come and talk to us at that. We've got some webinars coming up that are available for tax faculty members to watch. We've got on the 5th of June one on corporate interest restriction. We have I think it's the 16th of June, there's one on corporate losses. And then on the 9th of July, we have Sue, who are going to be talking about property income, one of your favourite subjects, Sue. So we hope to see you at Accountex, and all that remains is for us to say thank you very much for watching today's Tax Talk.
Thank you. Bye.
Bye.